Hi, welcome to Crypto Made Easy. In today's tutorial, I want to talk about risk management in cryptocurrency trading and investment. Trust me, this is one of the major reasons many people lose money in cryptocurrency. Lack of understanding of risk management processes. So today's tutorial, we're going to be talking about what risk management is. We'll talk about the stages of risk management and the various risks that are associated with cryptocurrency, where we'll talk about systemic risk, market risk, liquidity risk, operational risk, and then finally we'll talk about how you can mitigate these risks associated with cryptocurrency, whether as a trader or as an investor. So I want to encourage you, if this is your first time of coming to this channel, please kindly subscribe to my channel and please give this video a thumbs up so that YouTube can show it to more persons who will definitely benefit from the information in this particular video. So let's get into it. Risk management is a process of reducing the risks associated with a project to an acceptable level. The point here is this: there is a risk associated with everything, any project, any activity you want to carry out, whether it is going out, traveling, or whatever it is you do, even eating, drinking water. There are risks associated with everything you do. And so risk management really is a process of reducing the risks. You can't completely eliminate the risks, but you can reduce the risk. Okay, so if the risk of a particular project or activity cannot be reduced to an acceptable level, then it is better not to embark on that particular project. So risk management as it relates to cryptocurrency is the processes, the things you do even before you get involved in cryptocurrency or while you are involved in cryptocurrency to ensure that you do not get wrecked, that you do not lose all your capital. Okay, so that is what this video is about. And risk management can be applied to anything, but in this video, we want to narrow it down to how you can apply it to managing your portfolio and your involvement in cryptocurrency. So, what are the processes? What are the steps involved in risk management? There are basically different steps involved in risk management, and the first of it is risk identification. This is where you take time to name the various risks that are involved, that are associated with that particular project or activity you want to embark upon. Okay, so risk identification in this case, as it relates to my cryptocurrency, will involve you trying to identify the risks. If I'm getting involved in cryptocurrency, what are the risks I'm taking? What are these? What are the things? What are the risks I'm likely to face? And what is the impact of these risks? So the first step is to identify the risk. Then the second step is to analyze the risk, determine the frequency of occurrence, and determine the level of certainty or uncertainty of the risks that are involved in that particular venture or that particular project, or in this case, in cryptocurrency in general. Okay, so once you've identified the risk involved in cryptocurrency, the next thing you want to do is to analyze the risk. How frequent do these things happen? And when they happen, what is usually the certainty of occurrence? What is the certainty that this particular thing is going to happen? And what are the things you can put in place to ensure that you reduce their occurrence or their impact, as the case may be? So after identifying the risk and you analyze the frequency of occurrence, determining the level of certainty or uncertainty, the next step is to prioritize the risk, estimate the impact of the risk on the entire project. Okay, so in this case now, you want to be involved in cryptocurrency, or you are already involved in cryptocurrency, either as an investor or as a trader. Okay, so you want to know what is the impact of a particular risk that you have identified on your portfolio. What is the risk on a particular trade? What is the risk on your entire worth, as the case may be. So you want to estimate the impact of each of these risks. And once you've estimated, the next step is to try to mitigate, try to reduce, try to bring the risk to a level that is acceptable. Because, like I said previously, it is almost impossible to completely avoid risks in any venture. So your goal will be to reduce the risk, to lower it to the barest minimum, so that the impact of that risk will be very small on you. And that is what we'll go into in the next slide. So once you've identified the risk and you've analyzed the frequency and you've ranked the risk, prioritizing the ones that come first and then trying to tackle those ones first, then you put in the measures to ensure that you lower the impact of those risks. And the next thing you want to do is to monitor the risk and review your decisions, because your your measures may be working short term but may not be working long term. So you want to monitor and then try to review your decisions along the way. So let's be a little bit more specific to cryptocurrency and put these various steps into perspective. What are the risks associated with cryptocurrency? There are different types of risks, and these different types of risks have different frequency of occurrence and they have different impact. Or should I say, almost all of them have similar impact. So, what's the first risk? The first risk is market risk. This is the risk associated with the loss or with an asset losing value. When an asset loses value, for example, recently Bitcoin, which was trading at about $69,000, dropped to somewhere around $48,000. That is a loss in the value of Bitcoin. And this loss is frequent. So talking about the frequency of occurrence now, it is frequent. You cannot expect the value of a particular coin or token to be appreciating all the time. Sometimes they drop, especially in the short term, they drop and then they pick up again. So these are the market risks involved with cryptocurrency: frequent loss in the value of an asset. And what is the impact of of that risk? The impact can be that it can make someone bankrupt. For example, someone that goes into cryptocurrency trading a Bitcoin, probably his or her expectation is that Bitcoin is going to rise to $100,000, which is possible, but in the interim, the price of Bitcoin has dropped to somewhere around $51,000. So what happens? This person, if the person actually traded futures and he went long, he or she will probably have been liquidated. And if the person did not activate proper risk management measures, that particular person may have gone in with all of his or her assets and thereby becoming bankrupt when there is liquidation. Okay, so that is the market risk, and it is frequent, like I said, and the impact can be that one can be bankrupt, or there could be a loss of assets. Then we talk about liquidity risk. Liquidity risk is the loss arising from inability to find buyers for your asset. Let's say, and this risk is very common for shitcoins. The frequency is common for shitcoins. It is not so common for more popular and use case coins like Bitcoin, Ethereum, BNB, and the rest. But shitcoins, it is very common that you could buy a particular shitcoin and then you're trying to swap it and you can't find buyers. And what happens? What's the impact of this particular risk? The impact could be permanent loss of assets. Let's say you put in $100 to purchase that particular shitcoin. Now you want to swap it in order to get back your $100 or even with interest, and you can't find buyers. So it could lead to a permanent loss of your $100 or whatever amount you put in into that particular shitcoin. So liquidity risk is also a risk that is very common for shitcoins, not very common for more popular and well embraced coins. So let's talk about operational risk. Now, operational risk has to do with the losses that arise from human errors, from hardware, software errors, and even fraudulent activities. This risk is usually not very common for people who are advanced, who have studied the cryptocurrency ecosystem very well, and they know their way around. But for people who are just coming in, for newbies, it could be a common loss. It could be a common cause of loss because someone, for example, maybe human error. Now, someone who is trying to send a 100 BEP20 USDT to an address may end up sending it to TRC20. And if you send TRC20 to BEP20, you may end up losing your coin. So it is a common occurrence for people who are new. But for those who have studied and who have become very used to the ecosystem, they may not find it very common. Another, it could also be common for people. It's common for people who are new because usually they are the ones who fall prey to fraudulent activities, whereby they begin to patronize people buying from P2P platforms where there is no standard um method of operation, and they could end up losing their coins, or they may be involved in one scam or another, and the impact could be a permanent loss of assets. So operational risk is common for people who are new to cryptocurrency. And then we have systemic risk. Systemic risk in this case we have to do with losses that are caused by the failure of strong players in the industry. Of course, in the industry of cryptocurrency, we have strong players, the centralized exchange like Binance, KuCoin, and the rest. We have decentralized exchange platforms. We can even have a blockchain hack. This is a systemic risk. Yes, frequency it is not common, these things are not common. A hack of Binance is not very common. Blockchain hack is almost impossible according to experts. But the risk is still there. It is possible, but not common. And the impact of that particular risk could be a permanent loss of asset. So one of the things we get from this particular slide is that there could be a possibility of permanent loss of asset when you are involved with cryptocurrency. And that is one of the first things you should always have at the back of your mind, that you could lose all your asset, all your assets in cryptocurrency. So having known the risks associated with cryptocurrency, let's talk about how we can mitigate these risks so that you're not you're not one of those who will make money and then end up losing the money, or you're not one of those who will put in money and their money is gone because they are involved in one thing or the other. So what are the risk management uh, processes we can put in place to mitigate the risks associated with cryptocurrency investment? So with cryptocurrency investment, one of the first thing you want to do to reduce the risk is to diversify your investment. Diversify your investment. Diversifying your investment will help to tackle systemic risk. Systemic risk, like I said, is not common, yes, but it is possible. And that is why you should not put in all your assets into cryptocurrency. You could have some assets in cryptocurrency and have some assets in real estate and have some assets in stocks and bonds. Have businesses that are giving you money instead of putting every of your investment into cryptocurrency. So once you diversify your investment, it will help you to not get wrecked, to not become bankrupt when there is a systemic hack, or when there is a major hack or major loss, widespread loss in the market. So one of the first things you want to do is to diversify your investment. Another thing you want to do is to invest only in solid projects with good development team, real life use cases, and widespread adoption. There are coins, there are tokens that are useful in real life. They have widespread adoption. They have good people who are good good developers who are in charge of the project. And so when you invest in those types of coins and tokens, you can be sure that your investment to a very great extent is secure. But when you invest in shit coins and all those type of coins and tokens, you may end up losing all your assets. And that is why it is recommended that you avoid scam tokens and shit coins. Those coins and tokens could give you times 100, times 1000, times 3000% of your investment, but they can also lead to a permanent loss of your investment. So you want to be very careful when you're investing in shitcoins. It is preferable you don't invest in shitcoins, but if you must invest in those coins, you should be using a very marginal amount of your asset. Then avoid using shady exchanges, wallets, and P2P platforms. There are hundreds of centralized exchanges out there. Not all of them are very good, have very good practices. You would want to avoid them to prevent a situation of whereby there is a hack and then everybody's asset is gone. So by all means, try to avoid shady exchanges, wallets, P2P platforms. They could make away with your money. And then you want to invest only an amount you can lose. Invest only an amount you can lose. If you invest more than the amount you can afford to lose, then you end up depressed when there is a loss, because losses are almost inevitable in cryptocurrency. So the best way to reduce the impact of those losses is to minimize the amount of investment you make in cryptocurrency. Don't invest a lot of money that when you lose it, you end up having heart attack and hypertension. And another thing, you want to resist the temptation to be greedy. Greed is one of the quickest or the easiest ways to lose all your coins and tokens in cryptocurrency. When you're asked to invest and in the next few days you're going to be having times 10 of your investment. It is possible, but it is very, very unlikely. And it is possible that those platforms that are giving you such offers, or those coins that are giving you such promises, could be scam tokens or coins, and they are just waiting for people to invest, and then they will rock pull, take out the liquidity, and you are left with coins and tokens that you cannot find buyers for. So resist the temptation to be greedy and invest in your knowledge of cryptocurrency. Before you start investing, you should have first of all invested in your knowledge of cryptocurrency. The more you know, the more you're likely to earn. And so it is safer to invest in your knowledge. It will help you to identify situations that are likely to be to be scam. It will help you to know when the developers of a particular coin or token are not being straightforward. It will help you to know, to be able to carry out fundamental and technical analysis, to know when to invest and how much to invest and all that. So it is very important that you invest in your knowledge of cryptocurrency before you start investing in cryptocurrency. So let's talk about some specific measures we can use to mitigate risks associated with cryptocurrency trading, because trading is more of a more frequent buying and selling kind of situation. So let's look at some of the things you can do to reduce the risks that are associated with cryptocurrency trading. And one of the first things you would want to do to reduce the risk of losing your asset in crypto trading is to carry out technical analysis. Technical analysis will help you to be able to confidently, or to a great extent, predict what is likely to happen in the future. Like as it is said, history repeats itself. And so technical analysis helps you to be able to know what has happened and to be able to predict what is likely to happen. And this is very important for you to trade profitably. If you don't invest in knowing technical analysis, you may end up chasing green candles and buying when you're supposed to be selling, and you end up losing a lot of money. Another thing you want to do is to always determine your invalidation point before each trade. The invalidation point is the point at which the reason for entry of that trade has been nullified. So when the reason for entering a particular trade has been nullified, the best thing is to get out of that trade. Don't hope for a change. Get out of the trade. So if you don't determine beforehand your invalidation point, then you will not be able to set a stop loss. And if you don't set a stop loss, then you're very likely to be liquidated when the trade goes against you, especially if you're trading futures. So it is very, very important that you set a stop loss. It is, in fact, setting a stop loss is one of the most fundamental risk management measures when it comes to cryptocurrency trading, because it is better to lose 50% of your investment, 50% of the money you are using to trade, than it is to lose 100% of it. If you lose 50% of that money, you could use the remaining 50% to enter a new trade, and you could make a gain, and eventually you have you have your money back, and even you have gain on it. But if you don't set a stop loss and you lose 100% of your of the margin that you use for that particular trade, then you are left with no option than to go look for money elsewhere to put in order to trade again. Or you may be out of asset and you can't trade again. So it is always very important. I can't over stress it, that you set a stop loss for each trade. And then another very important measure you should use when trading crypto is to ensure that you don't use more than 5% of your trading asset on a trade. In a previous video, I talked about how you should always divide the total amount you want to invest in crypto into two. And let's say you're putting 50% into investment, or even you can even put 80% of your asset into investment, whereby you're buying a particular coin that you have studied the fundamentals, and you see the projection, and you buy that particular coin or token, and you leave it for years if possible. But trading is more like a day-to-day, or is a more frequent activity. So you want to put in less amount of your asset into trading. So let's say you're putting 20% of your asset into trading, and then that 20%, let's assume that that 20% is $100. So the total trading amount you have is $100. Now, for each trade you want to do, you want to ensure that you don't use more than 5% of that $100 on a trade. This is because no matter how good you are with technical analysis, no matter how good you are with coming up with winning trades, there is going to be a time where you are going to be losing on your trades, and you're going to be losing consecutively. So if you are using, let's say, 30% on 30% of your trading asset on a single trade, what happens when you lose three consecutive times? That means you've already lost 90% of your trading asset on three different trades that went wrong. So it is always advisable to use not more than 5%. Some experts say it is better to use 3% of your asset on a trade. And if you lose that particular 3%, you still have 97%, which you can use another 3% out of it on another trade, and you end up making back your money. So it is always advisable. Don't use more than 5% of your trading asset on a trade. When I say on a trade, now I'm saying, let's say you're trading BTC USDT. Don't use more than 5% on one trade. Of, let's say you want to go long, and you say on a BTC USDT, use 5% of your asset on that. If you want to go short on BNB USDT, use 5%. Don't use more than 5% of your asset on a trade. Then don't become too attached to a coin or token. Many people do this and it results to losses. They could see a coin that the coin is going against them, the trend is going against them. That particular coin is losing value, and they hold on to it. They be like, oh, it's going to bounce back. It's going to bounce back. And the more they become attached to that particular coin, the more they involve in trades that will result to losses because of their attachment to a particular coin. What you want to do is to study the technical aspect of the market, work with the technicals, go with what is trending. Don't trade against the trend. Don't go long on BTC because you hope that BTC is going to increase in value. When the market is in a downtrend, look for selling positions. When the market is in an uptrend, look for buying positions. So always go with the trend. Don't trade against the trend. And then one of the best things that you can do to mitigate your losses in cryptocurrency is to develop a unique trading strategy. Now, what do I mean by that? The trading strategy is a plan of how you want to trade. So it is very important that you have a trading strategy. And when you have a trading strategy, you should be sure to follow that particular trading strategy. Because it is one thing to have a trading strategy, it is another thing to follow it. So develop a unique trading strategy, because what works for one person may not necessarily work for you. And I have a video on trading strategy on my channel, which you can check out immediately after this video. And if you will need help on developing your unique trading strategy, you can check out the link in the description, and I'll be able to put you through, and we'll work together on developing a unique trading strategy that ensures you're making money instead of losing money. So with the steps I've outlined in this particular video, you should be able to know how to manage your risks in cryptocurrency. Ensure that you are one of the 5% who are always making profit, instead of being among the 95% others who are always crying when there is a market, when there is a retracement in the market, or when there is a downtrend or whatever, because they don't carry out risk management practices. But you have known what to do. One of the things you do, research the coins or tokens you want to invest in, and then invest an amount you can confidently and comfortably lose. And you want to invest in your knowledge. And most importantly, if you are trading actively, you want to always use a stop loss. I cannot overemphasize the importance of using a stop loss. So if you found this video useful, please give this video a thumbs up. And if you've not subscribed to my channel, please kindly subscribe to the channel. It means a lot to me. And I'll see you in my next video.